Merry Christmas, everyone. Is it a bit premature, isn't it? Yeah. Good evening, everyone. My name is Ishmael Hinds. Everyone calls me Ish. I'm the good tax man. Essentially, I help you access government funding. My company is Zee Razaq. You don't, oh, thanks for telling me, Dan. It's another story. So essentially, we are a dedicated land remediation and research and development tax specialist with 20 years of experience in the industry. We are ACCA qualified, and we are really passionate about delivering a high quality service with a personal touch and a quick turnaround. We have 100% success rate with HMRC and really work closely with them for about the past 9 years anyway. Essentially, I'm the good tax man. I really am here to help property developers, property owners access government funding, tax reliefs that they actually do not know about, all right? So what are my services? What do I do? Land remediation relief and research and development tax relief. I'm going to go into each of these a little bit more deeper so you can get a bit more understanding exactly how it actually adds value to each environment. So what is land remediation relief? Essentially, this relief was actually started in 2001 to really help UK limited companies claim tax relief on expenditure incurred in dealing with contamination, derelict land or buildings. Yeah? So it's really a tax incentive that the government has put in place to clean up land and the development of contaminated and derelict. Yeah? So essentially, it's really something which is used to reinvigorate the land rather than it being derelict, unused, whether that be derelict petrol stations, something which has been littered with asbestos, to bring back to normal and renewable use. So in terms of a contaminated state, what I really want to do is kind of give you the definition so you actually really know from a HMRC point of view, but then actually bring it to layman terms, all right? So if it's contaminated, a land or building is contaminated when a substance presents that it's really, one, causing harm or could potentially cause harm, or is likely to cause pollution, groundwater, streams, river, coastal waters. So what is that exactly, and how does it potentially affect you guys or someone that you potentially know? I had a property development client probably about over a year ago who actually saved £57,000 back from their land remediation claim. They bought a plot of land, which is about an acre. It was littered with asbestos, a building was littered with asbestos. What they actually really wanted to do was take dog kennels and actually change that into multiple and single dwellings. How they could do that? They couldn't necessarily do that, it was contaminated, but it does fall underneath land remediation because there's asbestos in terms of roof paneling, complete removal or capping essentially. If there's any sulfate contamination in terms of soil and concrete which you've purchased, it could be eligible for land remediation. Any hydrocarbon contamination in terms of fuels, oils, like I said, any derelict petrol stations, let's say you've purchased or whatever, that could fall underneath land remediation. Any pollution in terms of heavy metals, industrial processes, ground, the landfill gases, that could all necessarily be under land remediation. I think probably one of the biggest areas for myself would probably be Japanese knotweed and asbestos. Japanese knotweed, as you already know, or if you do not know, it could really affect a property in terms of the building itself. If you've purchased a property which has Japanese knotweed and it's destroying the property and you've actually had to pump money into it in terms of demolition companies, your time, any materials which you have actually put into that, you can claim some of that back and offset it against your corporation tax, or if you're loss making, get a tax credit from HMRC. A lot of people don't necessarily know that, hence why I'm the good tax man to help you get money back from HMRC. Any arsenic land in nature, all of these things here, we can actually help you as long as it qualifies essentially. So in terms of derelict land, so to be derelict, the land must be out of use in terms of productive use and incapable to be brought back into productive use unless the building or structures on it are removed, okay? So leaving it to, let's say, the first example which I gave where I had one of my clients who purchased a property littered with asbestos and they had to actually get that rid of before they can actually build on it and put the dwellings on it. Once that was the case, it was kind of deemed as derelict. To be counted as long-term derelict land, the land must be derelict since earlier of when the site was acquired by the claimant company or the 1st of April 1998. Don't ask me why, it's just what HMRC sees fit as kind of long-term derelict land anyway. So the relief is really given for expenditure incurred in removing the following structures which is left from a previous occupation on the site. So post-tension concrete constructions, building foundations and machinery bases, reinforced concrete pile caps. So if you, let's say if you kind of actually purchase a property and there's pile caps deep down into the ground, and you've had to remove that, it could really be qualifying for land remediation. Reinforced concrete basements, below ground redundant services such as gas, water, electricity, telecommunications. A lot of people actually have this in their properties or properties that they've bought, take it all out and go about their business. However, they could be saving necessarily tens of thousands or £20,000 on a tax relief. When can you actually claim for land remediation? A lot of clients come to me and say, Ish, well, I'm working on a project now, or I'm working on a project in about a year's time. However, you can actually claim 2 years retrospectively from your financial year end. So let's say if you are a December 2023 year end, you can actually claim back from your December 2021 accounts. So all the projects which you have actually incurred from then until now, if any of those hit those criteria, you can actually claim land remediation on that, okay? How can you realize the benefit? It's probably a good question which I always get asked. There's probably 4 different kind of ways which clients can actually generate this benefit. So the first one is a tax credit. If you're a loss-making company, a lot of people come to me and say, Ish, well, I'm loss-making, can I actually qualify for this? However, if you're loss-making, it actually is more beneficial than profit-making. You can claim up to 24p out of every pound spent on land remediation. So you get that in the form of a tax credit, which is straight cash from HMRC. If you're profit-making, and let's say you've paid already your corporation tax, if we put this claim for you, you get a corporation tax refund. Let's say if your corporation tax is going to be in March, we can literally offset it and you can get a corporation tax reduction, okay? Some companies said to me, well, Ish, look, I bought this site, I've bought this land, it's probably about, and probably 2 properties on it, it's about £1 million. Now I'm in a loss. I've helped them claim back land remediation relief. However, they know they're going to sell those 2 plots, I'm going to be in the green. They're going to be in profit. Some people don't necessarily like to take out that tax credit here. What they would necessarily do is carry the losses forward and offset it against your profit, which means you don't necessarily have to pay your profits in future years, which is probably kind of smart tax in that sense. You can claim more back in that sense rather than taking your tax credit. So this is one of the examples of my clients. Obviously, I didn't put a name on the slide, but it's a property developer, who is loss-making. And in terms of this incentive, what you can actually claim back is probably around 3 different cost categories. So the first one is staff costs. We can claim apportionment of your gross salary, pension, NI, bonus, reimbursed travel costs, okay? So a lot of people think to themselves, okay, Ish, I've done land remediation, I've taken away asbestos, I've taken away Japanese knotweed, I've hired out a demolition company, that's it. However, you can claim an apportionment of your time which you've spent working on that project for the year. So let's say if you've got 3 people working on £20,000 per year, £20,000 per year, we can take an apportionment of that. So let's say if they worked 30% of their time on that project, we can take 30% of each 20,000 and actually claim for that for the year. So they claimed £70,000 in terms of staff cost, 133 in terms of subcontractor costs, and it came to 204,000 in terms of qualifying expenditure. And out of that, we can claim up to 24%, so they've got a benefit of just shy of £50,000 back from land remediation on this site anyway.
Ish, how would you prove a staff cost?
Pardon?
How would you prove a staff cost?
We'll prove staff costs in the sense of how much time was spent in terms of actually excavating the land and decontaminating the land. So what HMRC says is as long as it's a fair and reasonable estimate, they'll be able to claim it back. They understand that a lot of companies may not necessarily have timesheets and be timekeeping to the T. So as long as we're not taking the mick, we could say, if we take a whole working year and we take it down to a working week, if you spend 1 day out of those working weeks on land remediation, we'll say 20%. 2 days 40, 3 days 60, 4 days 80, 5 days 95. And we'll kind of go for each employee, even if it's minimal, even if you're in accounts, however, you've actually had to go and book the demolition company, go through the accounts and actually go through the books to actually make sure everything is to the penny, to the pound, and make sure everything is running smoothly. All of those costs, whether that be 5% of your time, 5% of, I'd rather take 5% of £100,000 than take nothing of £100,000. Do you know what I mean? Does that help?
Yeah.
Wicked, man.
Ish, I've got one more question.
No. I was just about to. No, go on.
You mentioned demolition before.
Correct.
So I just wanted clarity in my mind. Do you need to demolish the building? Or you've got a grade 2 listed building, you take the asbestos out of it, you can claim this relief?
Correct. You don't necessarily have to demolish the property.
What's the entire building? Thank you.
Yeah, you're 100%. It was just from that scenario. They had a demolition company. They wanted to actually then rebuild it, but they realized that in the actual fact, so rather than doing dog kennels and actually put it into multiple and single dwellings, they thought they'd actually try and do a different way in terms of putting steel beams in it, which didn't actually work. So they had to demolish the whole property, take out the asbestos. That's why that cost incurred anyway, that project.
Right.
Last question.
Yeah, no, it's all right. I was going to say question at the end, but go on.
No, so I just don't understand in my mind. So are these not just bona fide expenses that you would otherwise offset anyway? Or are you taking, is this, you know, a business or a property venture operates, it incurs expenses, these expenses reduce its taxable profit. Is this an additional?
Correct. It's an additional, basically, additional incentive which the government have put in place, but not a lot of people actually know this exists. So what I'm going to talk about is two. There's land remediation and there's research and development. So this is a additional tax incentive which you can get to offset your corporation tax. So let's say if you've done what you can, your accountant's brought it down to £20,000. Now I'll come in and say, okay, exactly what you've done on the project, and I can go, all right, actually, rather than that £20,000 in terms of corporation tax refund you need to pay, I'm going to wipe that out for you, and then I'm going to bring you further down into an artificial loss, and then give you straight cash back from HMRC. So you could literally be 50 grand in the green, rather than just being 20 grand you have to pay, offset, and then you actually get another £30,000 back, depending on how much you've spent. The next scenario is a profit-making property developer slash house builder, a client of mine. They spend around £100,000 in terms of remediation work. So it's slightly different. What HMRC allows you to do is actually inflate the £100,000 by 150% to 150, then also add a super deduction of 50%. So what we're allowed to do is take 50% of this £100,000 and then surrender the lower amount for 25%, which is why it's 12,500 in comparison to this client who got just shy of £50,000. Okay?
Because they're profit makers.
Correct, exactly. The next incentive I'd like to talk about is research and development tax relief. It's probably something which I've been working on even longer than land remediation relief, which I think as well, a lot of people don't necessarily think in terms of the property world it's as prominent. There's been probably a lot of negative press about research and development claims and how you can claim for it in this current climate, especially within construction. However, if you're knowledgeable about it, you know exactly what you're doing, you know the government guidelines, you know the reform, you know exactly what they need in that technical report and that technical narrative, you'll be totally fine. I'm not selling myself, but I'm just letting you know. So what is research and development tax relief? So HMRC rewards UK limited companies who seek research or develop in advance in their field. So as long as you're satisfying two criteria, you can qualify for research and development tax relief. So the first criteria is an advance in your industry. That could even be a small iteration. So there's probably around 3 different types of advances which HMRC would usually say is an advance in research and development. The first one is creating a new process, a new system. It's not necessarily launching a rocket into space as such. If you literally created a new app, if you created a new process on a grade 2 listed building, if you're in a grade 2 listed building, you can't necessarily change the integrity of the front of the building, you're going to have to erect it in a different way. That's going to be an advance. If there's a way to actually erect it, however, you've actually said to yourself, this doesn't necessarily work for this solution, and you create something which is bespoke on top of that, that is classed as a bespoke or additional advance on that. Then there's a third one, which is a duplication of technology or engineering. Essentially what that is, if there's something out there and it's not public in the public domain, you're going to have to reverse engineer it exactly to how it actually works and from the inception in the beginning. That's also going to be an advance. The second criteria is it has to be technologically or scientifically uncertain how to achieve the outcome. HMRC loves to kind of babble you with jargon. It just basically has to be challenging to achieve your advance. So if I can go on Google and I could say, how am I actually going to create or reconstruct a grade 2 listed building? If it's there, it's not necessarily going to be challenging, right? Because it's going to be there. If I have to do different CAD modelings, speak to my architect, scratch my head, do different prototypes as to how I'm actually going to make this work, it's going to be technically uncertain how to do it. So examples of research and development in different industries, I'm probably going to use kind of different examples of clients that I've dealt with anyway. Construction, whether that be working on grade 2 listed buildings, working on a barn conversion, different ways of erecting a building or actually underpinning a house. That can be research and development. I've got a lot of mechanical engineering clients. Some of them have made components for Rolls Royce, components for cars, different widgets. That's going to be an advance. If in pharmaceutical, if you're creating a new cure for cancer, a different kind of paracetamol. I've had one of my clients had a paracetamol that goes in your system actually for longer than you actually need to and actually saves a lot of cost and has biodegradable bits in it. It's going to be research and development. If you've created a new app on your phone, 9 times out of 10, which is not necessarily available in the public domain, it's going to be research and development. Architecture, if you actually had to create, does anyone watch any of those architecture programs on Amazon where they actually start barn conversion and so forth? Just me? Yeah. I think there was one where they actually had a huge glass in terms of like a triangle and they had to put it between 2 houses. That will definitely be research and development because the architect had to actually hire structural engineers, work together, and all of those costs will be attributed to research and development. Food and drink. I've had a client who's actually created a new solution rather than using Red Bull, using natural remedies, because they were allergic to Red Bull, actually created substitutes. That was research and development. Aesthetics, I've actually got a client who's actually created a Botox which lasts 5 years rather than a couple of months. Research and development. So real life examples, a property developer, similar to land remediation, you can claim for staff costs, subcontracted costs, consumables, which are materials which has been used or transformed in the process and has no longer any commercial value. This can be included. They spent around £230,000 and just received shy of £60,000. Now, I think it's just kind of worth to actually add that just because you see this number of 48,000 and 169,000, a lot of people think, okay, well, I spend quite a lot on subcontracted costs, not a lot on staff costs. However, it's not necessarily you're going to have to be developing or doing the prototypes yourself. A lot of the times you could be testing the project, right? So when I was working for a large consultancy, they created a new system in-house. I'm not a developer. However, I know how a CRM system works, and it was my job to actually break the system in order to try and make it work. So we claimed an apportionment of my salary for testing. Similarly, if you're in construction, if you're actually creating a building, if I'm not necessarily building the project itself, however, if I'm assisting the person doing the CAD drawings or actually going back and forth and actually just reviewing the drawings, you can claim an apportionment of my cost for the claim. So they received £57,000 back. A mechanical engineering client of mine, total cost 201 and they claimed £66,000, 300. Now, the reason why this client here was paid less than this client, does anyone know why from the previous slides? Thank you, Ricky. This client was loss-making and this client was profit-making. So profit-making, you can claim up to 25p out of every pound spent on R&D. It's slightly changed now, which I'll kind of go into a little bit more depth in a minute. As to if you're loss-making, you can claim up to 33p out of every pound spent on research and development. So there's been a lot of changes in R&D from the 1st of April 2023 and also the 1st of August 2023. They said that no overseas subcontractors will be eligible for the R&D claim. They pushed it to August and then now they've pushed it to next year. I thought it's probably worth to kind of leave this here as the first one, because I'm not sure if anyone here claims for R&D. However, it's probably going to be worth to note that next year, any overseas R&D or people you actually choose to help you on the project wouldn't necessarily be able to actually be eligible for the claim. I think it's something which HMRC are actually putting in place now to make a lot more people be on PAYE rather than be as a subcontractor. Pure mathematical expenses will be eligible, so all of those drawings, if you're in construction and property development that you've actually done in terms of a building, and I know there's the planning phase, a lot of that will now be included. So if you spend, let's say, £10,000 or £5,000 on drawings from architects or whatever, before we could use the CAD drawings and so forth, but in terms of all of the mathematical aspect, we couldn't include. However, now that will be able to be eligible.
Sorry to jump in. So just to clarify, so if we're doing like conversion of our offices into like say like 10 flats,
Correct.
you're going to need drawings and you're going to need structural engineer calcs. All that can be classed as R&D.
Pure mathematics, yes, as long as they're calculations,
Really?
they can, yeah.
Wow.
Yeah.
Okay.
You could talk to me after if you want. How about it?
Yeah.
The claim must be signed by an officer, basically a director. You'll need the details of the advisor who you're actually helping you with the claim. If you've got any costs after the 1st of April 2023, you have to, and your year end is after the 1st of April 2023, you have to notify HMRC 6 months before you're going to do your R&D claim. So if this is your first ever R&D claim, you're going to have to notify HMRC. Basically, this incentive, before you're able to actually claim 2 years retrospectively from the claim. So if my year end is December 2023, you can claim up to December 2021. What they're actually doing is actually stopping that, so you can actually only claim for 1 year if you're a first time R&D claimant. This has always basically taken place because during COVID and just before COVID, there's a lot of cowboys coming into the industry and using it as a smash and grab when it's not necessarily for that. HMRC have undergone a reform to really make sure that the people who are actually doing R&D get the funds, and the people who are not necessarily, don't necessarily get that amount essentially. An additional form will need to be populated and sent to HMRC by an authorized agent. So there's a lot more kind of hoops to jump through to actually get this incentive. Am I in agreement with it? Yes, to a certain degree, and no to a certain degree, because I think it's hindering a lot of companies who are genuinely doing research and development, making them actually include more information from a technical perspective. So if you're writing a technical narrative now, whoever's writing it for you, you need to know and actually make sure it is actually red hot. If it's not red hot, the HMRC now 7 times out of 10 would actually launch an inquiry into your claim, and the inquiry process could probably take between 6 to 12 months for it to be resolved. So I would say if you're submitting an R&D claim now, it's more important now than ever to have a specialist to really look after your claim, understand exactly what needs to be included, and to make sure that they've actually got the right technical information to support the financials that you're actually claiming for. Oh, I kind of went over why the change is happening. Any questions?
So on the last one, on the R&D claim, you're saying that you can be challenged by HMRC.
Correct.
Going back to the previous one, the land remediation, is that a case-by-case basis that HMRC approves it and then you get the tax rebate, or are you open to or vulnerable to HMRC challenging LA Today? Because I know it's not the same thing as like stamp duty.
Correct, yeah.
SDLT reclaims. That's almost like a self-certifying.
Correct.
Setup, isn't it? So are you opening yourself to challenges further down the track, or are you pretty certain that you're going to get that money back, that tax back on the land remediation?
So land remediation, you're probably 9 times out of 10 able to get it back. HMRC say that they don't necessarily require any forms or anything. You have to put on your CT600 exactly how much you're claiming and they'll pay it out. I never do that. I make sure I've got a report because I don't necessarily want HMRC to question why you're actually claiming for £100,000 back. I'd rather you've got a report that can actually see exactly what's going on. The more information you give HMRC, the less likely they're actually going to open the inquiry. The less information you give them, the higher likely they'll actually say, actually, is that land remediation? What exactly are you doing over there? You know, so I'll say, it's better to give more than you need to. Obviously, you don't necessarily want to hang yourself a rope, but give them more than you actually need to in order so you don't necessarily get an inquiry. But it's possible that they can open inquiry at a later date if they think it's not land remediation or research and development. That's why I said it's so imperative that your technical report and exactly what you've been doing on those projects are really clear, defined, and make sure that they actually hit the criteria and more importantly, hit the legislation.
Just on that point, like what percentage of clients do actually go through that process where they're being...
Inquiry. Do you know what? Before 2020, myself, I didn't really see an inquiry really. I've only received, well, I've been trading 3.5 years, I've only seen myself had touch with 2 inquiries and we've got through unscathed. People I'm speaking with, my counterparts, I'm hearing inquiries going off like 40% of the times, just because they don't necessarily understand exactly what HMRC requires. So they literally put in stuff through which they would have put through 3 years ago, where it's changed now. Do you know what I mean? Does that help? No one else? No? Well, I've been Ishmael Hinds. Merry Christmas.
Ready?
Yeah, thank you. Thanks, Daniel, for
Pleasure.
the intro. Just to let everyone know, I have been feeling a bit under the weather. I had the old stomach bug. I have to drop that in, but I still...
Let me have it, all right? Let me have it.
Still, I made the effort coming down here. So, and it was my birthday yesterday, so look. So I do want to let everyone down because I know Dan's told everyone Zee's turning up, and then he'll be saying, so I've literally been in a coma most of today, but I've still managed to come here. So hopefully everyone gets a bit of value. I know I've done a presentation here before with people, a bit about background, and hopefully everyone can hear me. Usman, keep on nodding to me every time if you can't hear me back there. Is that we've got a lot of involvement and a lot of... I can hear Dan in the back there. All right, that means it's all good. So a lot of aspects around accountancy tax. I've been involved in the industry about 20 plus years. I've worked across industry as well as practice. Let the lady sit down. No problem. So I've worked for big brands like Santander, Mothercare, Connaught in construction, and also run my own practice. And we specialize in entrepreneurs who want to grow passive income as well as their trading income and unlock real financial freedom. Because many people don't understand what that means. That means generating cash flow, having assets that are going to pay for you in the future, and believe it or not, the crown jewel SSAS pensions. Got to have one of those if you're in the right position. Hopefully that all makes sense. So I'll cut through all of that. Dan's already done a bit of intro for me, which I'm appreciative of. Right, this is the agenda, what we're going to do. Because historically, there's so much going on in property. I guess if sitting here for people, you all got different property strategies, I guess, right? So I'm going to talk a bit about these because one of the things is, this is not an easy area to talk about. And obviously, I don't want to lose some people in the audience in the journey because it is complex, but I'm going to try to break it down to the bare essentials. I've noticed I've got some people also been on Sky TV there. Harold, so nice seeing you here. And I've done some episodes with him, so fantastic. We've got knowledge on financing, so any other people who look financing, really important. So I'm going to talk a bit about property strategies. Has everyone got a property strategy here? Or learning one? I hope so. Right. So I'm going to talk about some of the property strategies that are common and people probably don't understand what they mean in accountancy tax world. So I'm going to talk about, these are some of the popular strategies. This isn't a end-to-end list because there's co-living and loads of other aspects because that's quite a bit more complex. But I'm going to try to stick to these. So residential property, and I'll put some little stuff in the brackets to sort of make people start thinking differently. You have buy-to-lets, you have HMOs, service accommodation, furnished holiday lets. They are normal residential property in most aspects. They've got like people live there and stay there. That's what I mean by residential property. But as you can see, and I know Usman looking back there is going to love it, I'm mentioning capital allowances, These are the key things that change depending on what property strategy you do. I've also mentioned commercial property. An actual example is going to be a mixed property commercial with residential that I'm going to talk about, because that was quite a bit of a eye-opener for many people. It will be around how much you can actually save and benefit in tax, build your family legacy, and get to financial freedom quicker. Does that make sense? Yes. Has everyone sort of understand these property strategies? Honestly, if you don't, just put your hand up and I'll explain them quickly what I mean. No problem.
No, I do understand. I wonder.
Do you want to? Any questions? My colleague here, Lucas, is going to get it, so you'll be real famous, and he's going to put it on there so you can talk to it, because then it comes up. Perfect. Thank you.
Do I have to clip this on and feel like?
You can just hold it.
No, just talk.
Right, yeah.
So I wonder if we could add in there maybe as residential property 5, something to do with flipping properties, because I think
that's different. That's not
Really?
investment. I'm talking about property investment. I did do a presentation about flipping.
Interesting,
If
okay.
you're flipping and selling, good question by the way. What was your name, apologies?
My name's Greg.
Graham.
You can call Greg.
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 Right. So Greg asked about flipping. Flipping is when you buy a property and you have two purposes. Either you're going to hold it or sell it. If you sell it, you're a property developer, not a property investor. Total different tax world.
But if you keep selling them, like we're talking like doing 10, 20 in a year.
Yeah, but then you're a property developer.
Gotcha.
This is about property investment.
Gotcha.
There is a difference. This is for people who are holding on to property. Yeah? So when you're a property investor, what I mean by that, really good question by the way, Greg, is that you're holding these properties to get rent. Therefore, you're a property investor. If you get properties to develop and sell, you're actually a property developer. I did a presentation on this, and Dan will probably and we've got guides that you can download. So just learn the difference, because it's a big difference from an accountancy tax.
The difference between a trading company and investment company.
Exactly. Property developers, yes, property developers are trading businesses if they meet the criteria. Property investors are investment businesses. And that's quite relevant to what I'm about to talk. We can talk separately about it. I hope that answered the question.
That is perfect, Zee.
Perfect. Okay, so I'm just going to quickly say, buy-to-lets, what I mean by this is I'll get the whole house and I'll rent it out. Yeah, that's what I mean by buy-to-lets. HMOs, what I'm talking about is when you rent by the room. Yeah, house of multiple occupancy. Service accommodation is where, in my world, is where I'm getting a property that I'm renting out by the night. Right? And there's specific rules around this, bit like furnished holiday lets. Believe it or not, they've got special tax status. Right? That's why I said VAT and CA, capital allowances, are applicable depending on if you meet the criteria. Whereas in the other two examples, especially buy-to-lets, there aren't. Right? I know Usman will explain capital allowances. I'll just explain capital allowances are a way. In the UK, we can't claim depreciation on properties. In the US, you can, but not in the UK. So capital allowances are one way for us to claim the equivalent of depreciation. Yeah? Because you buy stuff, you invest in it, you don't get the write-off until you sell it, normally, except if you can claim capital allowances. VAT is a big driver, and I'm going to get onto it. Has anyone come across fun in VAT? Come on, don't be shy with me. Love it. Right, okay.
Did you see it'd be a good thing to do VAT and SSAS and how it works?
We could do that in a separate one, because it's sort of, but it's perfect. It's got candy. Right, I'm going to talk about the reason why I'm going to go into this is I'm going to focus on property investment group structures, because a lot of people come to me and ask me many questions in the last one around, Zee, you're going about these groups, why? Why are they important? And I did this presentation actually similar to this to about 50, 60 accountant tax advisors just last week. I will be going live on LinkedIn and YouTube very shortly, right? What we were talking about is when you invest in property, right, and I'm talking about some of the benefits, we tend to ask people what is their longer term strategy? What are they going to do? That's why I explained about property strategies, because the answer changes depending on what property strategy they're going to do. Right? A good way to look at it is, depending on what property strategy and what you want in the next 5, 10, 15 years, 20 years, some people even longer, depending on when they do, is setting up a holding company. And what I suggest when you set up a holding company, for it to be a family investment company. Does anyone know what a family investment company is? Some people call it smart company. Right. So those are companies where you're already thinking about inheritance tax, because property investment companies, all of that generally is part of your estate and therefore inheritance tax. Whereas what gentleman Greg was mentioning, that isn't part of your estate because you get special relief because it's a trading business. Even though probably Labour will be watching this, I heard Labour might change that. I don't think it'd be very popular, right? Because right now you get special relief if you've got a trading business like my accountancy business, property development business, you get something called business property relief. That doesn't apply here. So that's why you've got to think about inheritance tax. That holding company, if you do it once, this is the beauty, any company that you do a subsidiary of that follows the same thing. So you don't have to keep on setting up a family investment company every time you open a different business or you're about to do something slightly different. That's why you get it done at the beginning. Earlier you do it, depending on where you are in your property journey, you can actually get IHT down to 0. Right? It's 40%, just to let you know. Right?
Promises you can't keep, Zee.
I don't never do that. Right? That's why I've been on TV in front of millions and said the same. Right, okay. Right. The reason being is depending on your circumstances when you start and when you do this. Some people, they want to build up some property before they do it because it's an investment. Right? But ultimately, quicker you do it, the better, if you are going to scale your business. Right? And I'll go through some of the stuff on there. So that's your holding company. The other beauty of dividends, and I'm going to use a specific example of blocks, and we'll go through that later because that was quite an interesting eye-opener. But subsidiary A, in theory, could be the company that has VAT or stuff that's going to be VATable. Company B could be one that is all your stuff that's non-VATable, like HMOs, buy-to-lets. The reason why you want to split this, because VAT is a big headache. It can become a big headache because of something called partial exemption. And it's not like trading business where there's set rules. You have to agree this with HMRC. Has anyone dealt with HMRC apart from Ish and Osman? Yeah. No disrespect, I know they watch my stuff, but they can be quite difficult. And there's a different level of expertise depending on who you speak to. So by getting this idea in the beginning, how you're going to do this, it's going to be beneficial. The other bit of groups, before I get into it, is if I've got profits in my subsidiary A or subsidiary B, I can pay a dividend to my parent company, no tax. Yeah, because between companies in the same group, when you pay dividends, there is no tax. Yeah, special rules for offshore now, but I'm talking about UK-based businesses. Can you save it to the end? Is that okay? Or do you want, yeah? Okay. And then Lucas will come over. Right, the other bit is some complex transactions that I'm going to talk about, blocks, which is going to be interesting, is that if you don't get the planning done at the beginning, I heard people doing, anyone bought blocks or flats? Have you bought, great. Have you bought blocks with commercial properties and residential, mixed blocks? Right, you're going to love this. Okay, right, I'm going to go to the next slide and I'm going to get into some more of this fun. So I'm going to use a case study, one that we've just done pretty recently, just going to talk about numbers. So the acquisition of this misuse block was 4.5 million with a GDV probably of 8 million once some refurbishments are done. They've actually literally saved millions in tax. Keeping a promise there, Dan. Hope you're watching. And they protected their family legacy. This is really, really important. Obviously, they didn't just do this for tax. They did this because they want a sustainable business. And tax is one of the things that you've got to minimize when you want a sustainable business, because if you don't, before you know it, you're either making a loss or you'll soon run out of money very quickly. So this is very, very important. So what we did initially is we set up the parent company because we knew what they were going to do. We made it a family investment company. And therefore, in their case, their IHT going forward will be 0 because we've already planned it's going to go to the children and how that's going to be done. Okay? The next bit is, in this case, one of the other advantages which I probably didn't mention is people do intercompany loans. Does everyone know what that means? These intercompany loans can cause a lot of problems, and most people won't know about this. And most, unfortunately, accountants, especially probably who are generous, are not aware of the implications. If you do loans between companies and they become a material amount of your company, that can change your trading business's status for capital gains tax, or first of all, and then inheritance tax. That is a nasty aspect unless you resolve it. Yeah, you pay that money before you do a trigger event, we call, i.e. sell your shares of your company or sell your company. So really thinking about how you structure this and move your money around is so important. So that's one of the benefits of doing it within the group. The other bit is one of these we did was one of our clients bought a mixed block, and it's a recent example. And when they bought this block, it was subject to VAT, even though it had different parts of it sold off. It was commercial at the bottom, residential, but it had some interest in the commercial. Because of that, we structured it in a way within the current case law. Therefore, they actually saved VAT of about £900,000 on the acquisition, just to let you know, right? I think they paid very little of it. Very important, cash flow. Cash is king, queen, whatever people say, even though I think content is taken over now. But the reason why that's important is when you take VAT, you won't get loans. I know Harold's there and any other person who works in financing, you have to go for a different path to get loans to cover your VAT, right? And therefore, that saves financing costs on top and headache, and trying to claim the money back from HMRC if you've got a VAT registered company is a lot of fun. The other bit is, because of the special rules and because we know case law, this is the difference between Joe Bloggs, a generalist, and someone who actually is looking at what the legislation. We actually save stamp duty of about £80,000. That's quite a lot of money in this case. And it could have been more, but their circumstances only allowed that. That's in their pocket. That's reducing financing costs, more cash. The other bit is the way we structured it, because it was in a group and we knew what was going to happen post buying the property, and I'll get into that a bit, we're actually going to save corporation tax of about £100,000. So when you add all this up, this is in the millions. Is everyone understanding what I mean? The inheritance tax saving, the acquisition of VAT saving, the corporation tax and the stamp duty, all the classic taxes. The reason why we say corporation tax, and I know Usman's there, he knows what I'm talking about, is because we understood how to structure it and make sure we got agreement at the time of purchase on capital allowances in this example. Yeah, and there's special rules when it comes to blocks and things like this, and I'll just give a bit insight. Normally, I said earlier, residential you can't claim, but where there's HMOs or blocks, there's a lot of communal areas. And if there's a big area, you can actually do a claim on that. Very important, because that will reduce how much tax you pay, right? In this case, it's probably about 300 to 400 grand, hence the 100 grand with 25% corporation tax that they will earn without having to pay tax. And then if it's how you structure it, going back to knowing the rules of groups without boring everyone to death, it can be quite beneficial. In this case, the example that I'm going to talk about quickly is when this was bought, we bought it in the freehold because it was all on one. And everyone's probably heard title splitting, probably seen 50 million videos and things on that, right? This is how you do title splitting from a tax perspective and an accounting perspective. You buy, if you've got the freehold, in freehold code. That's why I called it freehold code, right? Then what you do, depending on the circumstances, is when you split it, the leases go into the leasehold and the freehold stays there. I'm going to add a level to this. If you've got commercial, you have to then decide, this is a thought process, whether it's applicable to capital allowances or not. If it is, I would recommend probably keeping it in the freehold, claim capital allowances on it, then split it, and you know what's coming next. Where do I sell it to once I've used the capital allowances? Anybody? What's the name of today's event? So now I've just taken, exactly. SSAS is a huge benefit in this because you used all the advantages in the taxable environment, And once you used it, you whacked it in the SAS and you've done it in the most efficient way. Because if you split it in a different way and don't do what I'm telling you, you will trigger stamp duty, land tax and potentially corporation tax or capital gains tax if you don't split it in the way I've said. That's the beauty of groups, right? So when I'm talking about, that's the second set of benefits on their journey, right? Because they want to, because obviously, as everyone knows, residential property can't end up in a pension, right? Generally, there is some exemptions to that rule. So this is why it's so important to get advice. So I wanted to go through an example because everyone's like, Zee, there's so much stuff, and we're like, whew, right? So I'm trying to explain property strategies and how to actually use them in the framework relevant to some of the strategies. And this can change depending on your circumstances. So before anyone says, oh, Zee said I've got the perfect foolproof method that works on everything, that's not the case. It depends on your circumstances, an evaluation done, preferably before you acquire the property, because if you don't, you'll lose a lot of benefits. And we've seen that a lot because the lawyers, no disrespect to them, my sister's one, that's not their expertise. Their expertise is conveyancing, not tax. And I think that's how they should stick to personally, right? Because it causes a lot of problems. Because who's that? Oh, my sister's one, so don't worry about it. Right, so it's really important having the right team. So generally when you do these transactions, your key parties, your accountant, tax advisor, lawyer, financer, these are quite important relationships when you're actually buying these kind of properties. There will be other ones depending on what you're going to do, but if you don't have those in your power team, if we're allowed to say that, you're going to have problems. Does that make sense? How much time have I got for Q&A?
Oh, yeah, you've got a bit,
Yeah? So Lucas here, one of my marketing team is going to move around, so when you ask questions, we can actually get it on the thing, because this will go to social media. Do you want to give it to Harold first? I don't know.
Zee, not many people here will know me, so I'm Howard Bowes from Harvey Bowes Financial Services. We've worked together on a couple of great deals.
Yeah.
2 questions for you, Zee, and the questions
give you a bonus one.
I'm always asking. Okay, so the first one is, we have the holding company, the freehold and the leasehold.
Mm-hmm.
Why don't we have just the freehold company owning the leasehold, or the other way around? Why do we have the group structure company? I have this structure myself, but my accountant can't tell me.
Right, really good question. So Harold, I said, why do I need to have 2 subsidiaries? The reason being is no lawyer is going to process having the freehold and leaseholds in the same company. It's a legal, apparently, aspect as well, right? Because they don't want those 2. So when you've got the freehold and everything on one, they're happy. As soon as you try splitting them, because you want the uplift potentially in value, depending on your particular project, they won't want that. They want it in a separate entity. And if you haven't got a group structure, you're going to trigger some taxes off, aren't you, doing it? Yeah? That is the major driver.
So,
and it splits your risk as well.
I accept the fact I might be stupid here.
Yeah.
So that, to me, that doesn't explain why you need a holding company.
Okay.
So Harvey Bowes, I have about 9, I think I have 9 companies on the. So if I have a company, if I have, everyone knows you, Zee, they don't know me. So if I've got Zee Property Limited, then why do I need Zee Property Holding Limited? Why can't I just have Zee Property Limited and then have the sub company where Zee Property Limited owns 75% or more of the shares, and then have Zee Property 2 Limited? Why do I need a third company in that structure?
Right, so just to clarify, Harold is asking, why do we need group structures and have a parent company? Really good question. So I'll answer the first part of it, this is the second part of it. The reason being is that holds your shares, right? If you start having your freehold held in just the parent, well, one company, and then have a subsidiary, if something happens to that company, it kills off everything, irrespective below it. There's a risk, huge risk, because if you own the freehold and something happens to, say, hold, in this case, imagine I just had 2 companies. Yeah, had that one holdco and then had leaseco, right? Yes, I could do that. Lawyers won't really care. But what would happen is something happens to holdco. It kills off leaseco, even though leaseco is still running. So it defeats the point of having a group structure. The parent company, just let everyone know, must just own the shares. No trading, no income through. That's the whole point of it. And then it facilitates the movement between the different subsidiaries, right? Without any risk. That's the reason.
Okay, then I would just have the lower risk company owning 75% or more of the shares of the greater risk company, and to me that would do the same. So,
but
unless
you've got to
you're
be
growing
careful.
bigger than this, I still don't understand the structure. That's all. So,
No, but what I'm saying is the holding company just owns the shares. You're saying it will hold the freehold as well. I'm saying to you that's a risk having the freehold in the holding company, because if anything happens in that company there, it'll kill off the subsidiary even though that's done nothing wrong. So what's the point of having two companies in that case, apart from doing the split? You're not diminishing your risk. Yeah? Someone who doesn't really understand it may do that, and I've seen that, where they've had the parent, what they call the parent, but it's actually a trading business or investment business, and they've got subsidiary, but something goes wrong, they have to go in liquidation, something happened, whatever reason, they've just killed their subsidiary, which was profitable, had no problems. That's why. I think that's very clear in my world. I hope that makes sense.
Thank you, Zee. Appreciate answering the question.
Thank you. Thank you for a great question, by the way. Oh, I think. Ask this gentleman here next to. Sorry, put your hand up. Your name?
Hi there. My name's Kai.
Kai. Okay.
Full-time investor developer. I've got a question just regarding the holding company. So
yes.
No, I'm familiar with family investment companies.
Yes.
Obviously, that's for family members and IHT purposes. But how about between sort of business partners? So if we've got sort of 4 unrelated parties coming together for a business venture, you know, with a sort of a 5 to 10 year plan, for example, you know, would you set up a holding company structure similar to this, similar to a family investment company?
Really quick question. Sorry, what was your name? Apologies.
Kai.
Kai, great question. Kai is asked, just for the audience, that he's got 4 people, including him, who are not related. Should they have one holding company? Is that a fair way of looking at it?
Essentially, yes. And how would that differ to a family investment company, or is it the same thing, essentially?
The family investment company is the name used when you have different class of shares, and the shares that are having the growth in them are to your children or your beneficiaries. Yeah. So if you set up a family investment company with, say, 4 different people, later, when I've seen people who have done this in the past, you're going to have problems, because you may have a good relationship, but are your kids going to have a good relationship with their kids or the beneficiaries? This is the problem by doing it that way. It may save cost initially, but the pain is going to be a lot bigger. I've had a few people, even families, where there have been 3 brothers. Yeah. One of the brothers has passed away. A lot of problems, and they're like, oh, this has got out of control now, because initially I would have suggested them to have their holding company one of their own, because ultimately that will be a legacy for their family. Yeah, everyone has different views on it, but ultimately you've got to think, who are you trying to protect, and who do you want to be able to get the benefit of all your hard work?
Okay, so the unique differentiating factor for an investment company is that you split the growth and then the income. That's basically it.
The income is different. I'm talking about you're splitting what the value is. So if I got a property and I bought this, if I did this beforehand and had the property, my company would have been worth 0. It's got no properties in it. If I freeze the value at 0 or £100, whatever your shares are, and then I put all the growth into the future, i.e. your beneficiaries, then I protected against inheritance tax upon death, because your estate will not have more than 100 quid added to it. If I do it later, it's whatever the point where it's frozen. So typically, without getting into a bit of a masterclass on family investment companies, you normally husband, wife, normal A and B shares, they will be called freezer shares, and then there'll be different share classes for growth, depending on, and then whether there are trusts involved or not.
But we could still, sorry to go on, Ron, but
no,
we
it's
could
cool.
still use a holding company structure between the 4 business partners unrelated.
You can.
Wouldn't have that growth element. That is.
No, you don't. If you're doing a family investment company, you can't. For me, it wouldn't be a family investment company.
No, but I mean, it wouldn't be that. It would just be a holding company between 4 partners.
Yeah.
But there'd be no growth element, because the growth element separation is a unique factor of investment company versus
family, yeah, because that's part of your estate.
Got it.
Yeah, as I said
Yeah.
at the beginning. So it's really important to get the advice, get it done at the beginning, get the structure, because you need accountancy, tax, legal, and probably, depending on if you've got any property finance, a review on the financing to make sure there's no issues or implications.
Okay.
Yeah, because you need that at a minimum.
Yeah.
Yeah, so they're not straightforward.
Okay.
Has that answered your question, Kai?
Yeah, I've got more questions, but I'll leave it for there.
We can catch up later.
Great. Yeah, thank you.
Lucas, I think. Yeah, great. And then there's, I think.
Hi, it's Greg again. Thanks, Zee. This is a quick one. So earlier you were telling a story of splitting the title, assigning the leases, and then sort of eating up all of the value and then selling it on to the SSAS. All of the
Right.
benefit.
So I was talking about the commercial potential element or the communal areas.
Would stamp duty not apply then when you transfer it onto
what
the
part?
when you transfer it onto the SSAS?
Depends, actually, really good question.
And is it possible that it won't apply or it can be exempt?
I love how you said that.
Really
So
know.
Greg is asking that if I've got the commercial element and I then sell it to the pension, will I trigger stamp duty land tax? Is that
Yeah, effectively,
right?
yeah.
So that depends on your circumstances. Yes. So there is actually some exemptions around that as well.
Okay, that's what I
yeah,
wanted.
but you need to look at your situation. But generally, does everyone know there's different stamp duty land tax for commercial property and residential property? Yeah. So if it's under 150,000, zero stamp, and then depends on your circumstances. It's total different rules to residential.
When you talk about it depending on your circumstances, what does that mean?
Think about how many different circumstances someone could be. Is it more than one person that owns the company? What type of commercial? What are you selling?
I thought
what
it was the bottom line that if it's over 150k.
Stamp duty land tax, like many things, is depending on your situation. Same as VAT. That's why you need expert advice and not just watch YouTube, even though it's quite powerful.
My man, thank you.
Perfect.
48 different variations on there.
I think there's loads, and it's just getting more because you got to remember when they introduced stamp duty and the way it is done, it's changed a lot. There's something called the Finance Act 2003, it goes through all these different variations, and then in 2016 they added loads more stuff in, which hammered a lot of property investors, like the 3% charge and all this. So there's been a lot of variations, and in the last year I've seen more cases on stamp duty land tax, funny enough, than anything else. So stuff that may have been allowed a year ago is not allowed now, where HMRC got their way by getting the legislation change if they lost, or they got guidance that they believe are going to win. And then it depends how big your pockets are if you want to fight that or not. So really get advice up to date on your situation because it is different. Yeah? Was that useful?
Very useful.
I think, got a gentleman right at the back. We know who he is. He's got some questions as well. Please state your name for the...
Thank you very much. Hi, I'm Hamish. So on the holding company structure, you're talking about it particularly in sort of title splitting, but in other circumstances where you would have multiple companies and then you'd have a holding company, is this something that's easy enough to set up at a later date? Because my broker is basically saying, don't do it now. Whatever you do, do not do it now because it makes financing a lot harder through mortgages and bridging and any other kind of finance, really.
Really good question. Hamish is talking about how much access to finance. Two questions you've asked. One is, does it affect access to finance, group structures? And I know Harold will be looking at me on that. Yes, it does. It depends on, but normally when you do these kind of things, you wouldn't go to Joe Blogg's bank. Just wouldn't. And by the way, I've got banking background about 5 years. I worked for Santander, managed their cost base, about 2.5 billion and saved them 100 million quid. So I think I know what I'm talking about. So yeah, I wouldn't be going to average Joe bank. I would go to a specialist lender, right? Number two, really important question is when can I do this, right? If you don't do it at the beginning, depending on your situation, you're going to need HMRC clearance. There's an office in Birmingham, without getting a lot of trouble, hard work, because you have to explain why you're asking for the structure, because you have to do something called imagine I've just got freehold code. Yeah, that's my only company. I've set it up, SPV, special purpose vehicle, fancy name to hold a limited company that holds property. And now I'm like, oh no, I'm buying a commercial block, I'm buying loads of different things, and I'm like, I need to get some value, I'm going to trigger all these taxes off. I have to ask permission from HMRC to add a holding company in. Yeah, and that's not an easy process, and it's not cheap because you need your accountant, tax and lawyer to speak to, and potentially a financer depending on their T&Cs. Yeah, because you have to get permission to do something called a share for share exchange. Yeah, and to get the reliefs, otherwise you don't want to trigger tax by getting a parent put in. Yeah, the two taxes are stamp duty. Yeah, I'm not calling it land tax, stamp duty, because that's for shares, and the second one is capital gains tax. And if it mirrors, so imagine I've got A and B in freehold co here, right? So a husband's got 50%, the wife's got 50%. That has to be the same in the holding company structure. So to not have to pay stamp duty and get HMRC clearance. You also have to go and pass certain tests. They just don't give it to you. There was a little period where they had to go to court a few times. So HMRC, believe it or not, do lose a lot of their cases, except we as a taxpayer are paying for it, so that's the challenge. They weren't having a lot of this because there was a new generation that didn't know what was going on. But you can do this, yeah, but it's harder, it costs more, because you need to then pay for that planning to be done. If you do it from the beginning and you know you're going to scale, you save a lot of pain and anguish and headache. And then it's weighing up your financing costs, how much that's going to cost you, all the rest of it, and additional accountancy costs probably of running those. But it's going to have huge benefits, in my opinion, if you're doing a proper property investment and you're scaling. But get an assessment done before you do anything. That's my a professional opinion. Has that answered your question?
Yeah. I mean, I think generally, if you're going to scale later, then maybe that's a better idea, right? You're making more money, so that absorb the cost later. Or is it an unbearable cost?
Yeah, I think a lot of people do it for inheritance tax like that, but my question is more depending on your property strategy, how quick you do it as well. Because if you remember at the beginning, I talked about VAT. I've spent a bit of time on VAT. Depending on your property strategy, what you're doing, some stuff is VATable and some isn't. That's a whole painful process. What you don't want to lose is the benefit of being able to claim VAT and yet still being able to have to charge VAT. Yeah, so if you're doing service accommodation, furnished holiday let, and then suddenly you say, I'm going to do a buy-to-let, that's a problem, isn't it, or HMO? It may sound like I'm just doing property, but they've got total different tax rules. So this is why you've got to think about this and have someone who understands and be able to reshape it accordingly. Yeah, because you have to sometimes change your decisions, and therefore getting the right advice will make a big difference. Does that sort of answer the question why you need to think about this?
Yeah, very much.
Perfect.
So, yeah.
Is there some more questions?
There is actually.
Okay,
on the title splitting, how do you see this changing based on the reforms that the government are talking about with leasehold?
Really good question. So Hamish is asking about the changes in the rules. I don't know the answer yet for those because I have to understand what they mean. Yeah, and then we would get what does that mean from an accountancy tax perspective, legal perspective, because in my head, is it a different variation of the same thing or is it totally different? And that's the bit that we're going to have to look at. I don't think they've been implemented yet, have they?
No, not yet. Probably
so it's all up in the air right now, along with in England about Section 21, I believe it is, isn't it? About non-fault evictions. They're not coming yet.
No, not Section 21. The leasehold changes.
I know. I'm saying that they were all in the same stuff that Michael Gove was talking about. That he was going to bring legislation, and he's put a hold to it. So there's a lot of stuff in that legislation which will have a lot of implications to property entrepreneurs, especially. But I think he's learned from some of the people I know who've spoken to him. Have said to me that I don't think he was fully aware of all the implications. For a guy who thinks he's got the size of brain of a planet, not very clever. Simple as that.
Brilliant. Thanks, Zee.
No problem, no problem.
Yeah, of course. Got another question over there?
Yeah, go on.
Hi, evening, everybody. My name is Yuri. It's the first time.
Sorry, say your name again?
Yuri.
Yuri. No problem, Yuri.
Nice meeting, everybody. You had residential property, then you had HMOs, and you had commercials, you had SSAS. But what if you take a HMO in my case, but any property?
Do you want to come a bit further up so I can hear you? Because I'm just hearing some of the stuff.
You take a HMO and
Yeah.
you lease it to a supported living provider.
Yeah.
Does it become a commercial from the tax perspective?
Right.
With capital allowances and Section 24 even.
Right, Section 24, right, let's break it up. There's about 3 or 4 questions in there. Yeah. Section 24, does everyone know what that is? Everyone quotes it. That's the tax on interest, finance restriction. Yeah. That only applies when you buy residential property in your own name. In the company, it doesn't apply. Yeah? So in this structure, that doesn't apply.
Now, I own this property since 2010.
Okay, so that's one aspect. Number 2 is when you sublease, right, the driver for tax is the how much time someone lives in it for residential. Are they staying 30 days and moving on, or is it a longer lease? With a lot of the FRI leases to the social housing, they don't have that aspect. And if it's just normal residential properties, not with special changes that are come under the rules, then you're just going to be a residential landlord.
No, you are signing a lease with a provider. And these people, they don't live on their own. They have 24-hour staff and all that kind of
what I said
support,
was, it depends on the circumstances of the individual. Generally, if you sublease, right, and it's more than 30 days, then you don't get the same kind of benefits as a commercial aspect as you do as residential. Yeah, so you need a valuation done. Does that qualify, and is there an exemption on that? Yeah, on your circumstances. But the general rule, I have to go by general rules because I don't know all the ins and outs, is that if it's a longer lease, right, more than 30 days, then it's not going to be short term, therefore it's going to be considered residential, right, and AST aspects, even though you've got an FRI lease in place, because they're 2 different things. And you've got to remember, for tax, it's got its own rules, which are not necessarily the same rules as planning. And you've got to understand that's why you need a valuation.
Even if you change the planning use to C2, because essentially it's C2, that there is, people that are looked after.
So if you do that, that will obviously convince, because you have to pass certain tests. So I would recommend an evaluation done on yours, and then look at the circumstances. Do they qualify? And then you can make a decision. Because is it the driver of getting the restriction of finance is your big driver, is it? Getting rid of Section 24?
There is capital allowances as well on the top, and there is all the benefits of commercial property. Obviously, you can sell it to a SSAS, and there is lots of benefits in there.
I would be very careful when I've got property that I sleep in, and I can sleep in, right, except the perfect exemptions, we call dwellings, to go into a SSAS pension. Everyone will have different views, but I deal with HMRC quite a lot, and they will be looking at it very differently. So you need to make sure care homes are an exception, right? They're actually stated in the legislation.
Kids' homes, an exception as well. So potentially you get a HMO, you turn it into a kids' home. Potentially,
but this depends on the strategy, and it goes back to look at your circumstances, making sure they meet the criteria of legitimate tax planning, not what someone did in their back garden and said, that's allowed.
So it depends on the provider.
Provided
it depends who they
on your
circumstances. What they're doing.
Depends on your circumstances. Has that answered your question?
Yeah.
Perfect.
Thank you.
Thank you so much.
Thank you.
Anybody else? I'll get onto a slide later. How does it work? So I'll point out, really good point on that. This is how we tend to normally work on these situations. My team does a fact find, they do the magic, I just try to talk a bit of good stuff around it. And then we have obviously a consultation, depending if we can help you. Because there was actually a client recently, most people you can help, but there was a client recently referred to me by another surtax franchisee to give specialist advice around property. In their circumstances, in their specific circumstances, there was nothing really we could change from what it is at the moment. So I phoned them up. I gave some extra tax advice to that tax advisor and accountant, but it wasn't around their property because they couldn't change it because of their circumstances. Very rare. Majority of people, you can do stuff for them depending on they know where they're going. And that's the hardest part, is to shape where they're going. I think I've got and this is how we work, and we'll leave it on there. Is everyone on LinkedIn here? So one thing, if you can do, connect with us on LinkedIn, Zee Razaq. I think there's only one running around on there. Z-E-E, surname Razaq, R-A-Z-A-Q, A-C-M-A, C-G-M-A, it says afterwards. And if there's any stuff, because we put a lot of content on there. These guys do a lot of stuff for me, and we then also put a lot of content on YouTube. I think we've got over 600 videos on YouTube. Second biggest search engine in the world, so you can search stuff on there. So we put a lot of content, but please, before you do stuff, my suggestion, whoever you're comfortable, get the advice at the beginning. It's going to save you. Like in that example, not just at the beginning, consistent, and then get a good team who have done it before. Because what I found a lot of times is people say a lot, but when it comes down to actually doing it, they don't, or they just fudge it, and ultimately the taxpayer is responsible. Right? And anyone who tells you otherwise, they're just blagging it to you, I'll be honest with you. So you need to make sure they know what they're doing, they understand it, and then give you the right advice from that. Sometimes I have to speak to specialists on all the different taxes. We've got a retainer, because every tax has case law, and that changes, and it doesn't always reflect in the legislation. Yeah? And that's how you get the benefit, because you need to know what is the rules right now when I'm doing it, not a year ago, 5 years ago, or 10 years ago, now. I hope that makes sense, people. So this is how we get on there. Obviously, we've done the Q&A. Is there any more questions?
Yeah, do you also cover...
Please, sorry.
Hello. Hi, I'm Blondine.
Sorry, what's your name?
Blondine.
Blondine?
Yes.
Traffic.
Do you also cover, in all this melting pot of different situations, do you also cover foreign affairs, foreign investment? So
yes,
my portfolio is overseas.
We cover when people are investing in the UK. The reason being is we've had a lot of questions, and I think I did a post just a few days ago, and we're doing a little video, because I've had a lot of people who are selling property that lived in the UK and moved on. What we don't necessarily cover is where there's a UK person investing in the foreign. We can do the UK part, but the broad part, we would try to find someone in that country. Really important. I think I did a Sky TV episode on this particular thing, and I think John Howard and the presenter were trying to have a bit of fun. Oh, what do you mean, Zee? You don't know all the taxes in the whole world? I said, have you saw the UK tax code recently? I was like, every country has slightly different rules, right? And I think I mentioned one in the US. They've got certain rules, we've got different rules. They have some similarities, especially Europe and Canada and US, but they have differences. So you need to know. So in most countries that I've seen, property is now treated differently to trading businesses. So they tax it in the country that you're earning the income. It seems to become a common thing. UK changed in 2015 for residential, and I think commercial changed in 2019. So depending on what country you're doing, what you're investing in, depending on their rules on how they treat all different properties, you may need dual advice. Yeah, and the two people or the key people to talk to each other, so you get it structured in the right way that you don't end up getting hurt twice.
Yeah.
Yeah,
that's that bit I wanted
the double
to know.
taxation
Yes.
relief. I did a whole video on Sky about how it works, so watch that. Quick one for double taxation, you have something called unilateral relief, right? That is, no, your default position is double taxation. This is a treaty between the two countries. UK has done a lot more because we're outside the EU on a lot of this stuff. And the second one is unilateral relief. So what unilateral relief means is, that's like a second default position. If I paid £100 tax in France, let's say, and the tax liability was £100 here, I could get a tax credit of £100 against my UK tax. Because in the UK, you've got to pay tax on your worldwide income. Did everyone hear that? You've got to pay tax in the UK on your worldwide income.
It's when you die as well.
It depends on what it is as well, and what the rules are.
Thank you.
Not when you die, it doesn't matter what it is. You have to declare.
So getting good advice.
They don't
Oh,
speak
there's
to
a
you when you
question
die.
over there.
It's your executor's legal obligation to disclose your assets globally when you die. So if you've got a little bolt hole in Italy, Portugal, Spain,
Thanks.
yeah. Well, just know that your executor has a legal obligation.
Last
when you
question?
die.
Yeah.
Last question, Dan?
Just
Last
oh,
one.
last one.
Hi, yeah, I'm Louise Reynolds.
Louise.
Can you remind me of the capital gains tax timings, procedure, and how you go about it for selling a residential property in personal name? The timings are now quite tight, aren't they, in terms of reporting and paying any CGT due?
Really good question for Louise. She's asking not about the stuff here, but something else around if I've got property in my own name and it's residential property, because that's quite relevant. If I sell it, how long do I have to report my capital gains tax? It's changed. A few years ago, it used to be in the same time as your self-assessment was due. Now, it changed to 30 days a few years ago, a couple of years back, and then they found out everyone was doing mass non-compliance. They've made it 60 days at the time of exchange. Right? That there is certain rules depending on what type of residential property, if it's your main residence or not, if there's tax to pay, because some properties, if they're your main residence, you have no tax to pay because of, does everyone know there's something called PPR, Principal Private Residence Relief, yeah? And so it really depends on that and if it's been claimed. If it is like an investment property and it's never been your main residence, you will have probably 60 days to do the return and pay a payment on an account, right? And then there's a second part. So imagine I bought it April 10th. There's a reason why I use April 10th. April 6th is the start of the tax year. I bought it on April 10, 2022, right? I had, let's say 2023, because I think the rule changed a bit. You have 60 days from then, if I sold the property, apologies, on that date to report it and do a return for CGT, 60 days. Then by January 2024, because that's the January after, I have to then put the actual numbers. Because when you're working out this, and I'm going to a bit technical mode here, you have to do a forecast of your income, because capital gains tax sits on top of income. So those are not your actual numbers. Actually, one of my colleagues who gave a good tutorial on this, actually, Pacific Point, it was last week at the Surtax conference on this and went into it nth degree around when you have to do the return, when you don't have to, what the implications are. Even if you've got the actual and you do a self-assessment, you still have to do the return in certain circumstances. It's madness. So
within that 60 days, you're just doing the forecast of income, and then what's the delay for actually reporting the actual figures?
The delay is because what is your actual numbers? Because the tax year
what is the time period?
January.
Right.
That's the deadline. So the January after the tax year. So if I use the example, 6th of April 2023, right? The tax year finishes 5th of April 2024. Right? Therefore, January 25, in that case, will be the time when I have to submit the latest, can't do it earlier, my actual tax return. Right? At that point, I have to put my actual numbers on. So what income I've actually earned in that tax year. Right? So if I've had employment income, I'm doing a forecast. If I've got property income, I'm doing a forecast. The reason being is, below 50 grand any gain, right, on residential is subject to 18%, and above it is subject to 28%. Okay. Any more questions that you're looking up on the... Is that okay?
Yeah,
Did I cover
I was just making a note. Yeah, no,
oh, excellent. Love it.
Yeah.
That's actionable advice. Love it.
And that'll be interesting for you, Blondin, because that's in Poland. Yeah. No.
SAS Bulgaria coming next year.
No, right. Do you want to have a question for this gentleman here, Lucas? Someone there. Someone who hasn't asked the question yet.
Hello, my name is Fatih. And for example, we got this.
What's your name, apologies?
Fatih. Fatih.
Right.
So, like Fatih. So.
I want to get this right. Don't want to upset nobody.
That's all right. So, for example, we got this holding company, and we got a freehold co and a leasehold co. But we got for example, investor from Qatar International, and he wanna do joint venture with 50-50 SVP company. Can we put on this system directly, or are you supporting us on this kind of international investment coming from abroad?
So, I think Harold was mentioning actually something really interesting. When you're moving stuff around in groups, there's a minimum requirement the parent company has to own. That's 75%. or
Okay.
more. Yeah,
Not 50.
yeah, because then you'll trigger taxes off. Because you get something called group relief. You only get that if the parent owns 75% or more. So depending on how you structure that investment, right, is very important. Yeah, on how you get their investment in, whether they're going to do it as a loan and some share equity, that depends on the agreement. But ultimately, you want the parent company to own 75% of your subsidiary if you're going to do this planning. Otherwise, you're going to end up triggering the taxes off.
Okay.
Yeah.
Sleep at night.
Sorry?
Can you sleep at night?
Well, I think having a bit of a stomach upset helped me. But apart from that, no.
If you drop a box of matches, he'll tell you how many there are.
I don't know. Do you know what? We come up with these different scenarios. I'm very appreciative of all the questions because
So
this is how
If
we
something happen like that, so you will support us.
Yeah, more than happy. Have a chat. My team will do a free thing, and then we can put it in.
Alright.
Because getting this advice and structuring is so important, right? And also explaining to the person who's investing, because there are some benefits to them depending on what you're doing as well.
So, for example, is it changing, for example, investor from different countries to countries? Does it affect the process?
It can do, but really what we're advising is UK tax implications.
Okay, yes.
Yeah, they would need advice in their home country on how that income is related.
So they
into
want to
their-
invest from their country to the UK.
Yeah, the UK bit, fine.
Okay.
That bit, we would have to get someone out that country, because you need to remember, you need to get end to end.
Okay.
I'll give you great advice, yeah, this, and you go in the country like, Zee, didn't tell us about this. Yeah, because every country has a different tax structure. They're not the same as the UK.
Okay. All right. Thank you so much. Cheers.
No problem. Thank you, Ray.
Brilliant. Have a one-to-one.
By the way, thank you for all the questions. Really appreciate it. And thank you for having me, and thank you for the patience, because I still don't feel 100%. So thank you.
Thank you very much.
Thank you. Cheers.